Earlier this morning we had a fascinating discussion about foreign investments, and I think a lot of people would have realized that foreign investments should be a key part of any investment portfolio. But foreign investments, you need to structure those investments properly, because there are different ways to do it and there are benefits and negativities attached to each of those options. So today we're going to just ventilate and discuss the options you have if you want to invest offshore, and to make sure that the benefits outweigh the negatives. Nadir Thokan is with me. He's an absolute expert at SEI. Thank you so much for joining me. We just had a tax discussion which I thought was very, very complicated. But how complicated is it for a normal person to say want to build a discretionary portfolio and allocate a significant portion to offshore investments? How difficult is or complex is that environment and those options that you have?
Yeah, so thanks for having me, Rex. So as you mentioned, I think it's critical that all investors in South Africa have a fair amount of their portfolio invested internationally, and I'm sure you've unpacked this in previous sessions, but the reality is that it has nothing to do with your faith in South Africa. It has nothing to do with where the rand is going. It just has to do with the sheer size of the opportunity set that's available globally relative to locally. So I think it doesn't matter how small your investment is. It doesn't matter how large your investment is. I think it's critical to be able to access offshore investments. And I think what's happened over the last couple of years, as National Treasury and the Reserve Bank has been gradually relaxing, the kind of limitations that there is to investing offshore, I think it has become a lot more accessible even to the smallest of investors. So if you think about, the investment list platforms, and a lot of them are very competitive now on their pricing because they're trying to capture the mass market or the mass retail market, if you will. So now investors can allocate to offshore markets without even using any of their own foreign allowance. They can buy, in essence, a piece of the foreign allowance of a number of service providers, whether that be a stockbroker, whether that be a list platform, and allocate to an offshore fund directly. And then, of course, there are also rand feeder funds, which is essentially giving you exposure to exactly the same offshore investment with you just investing in rands. And I guess the only challenge with a rand feeder fund is that when you disinvest from that portfolio, you're going to be redeemed and paid back in rand. So that money can't be paid into an offshore bank account. But certainly over the last couple of years, through list platforms, through feeder funds, through brokers, allowing, individual investors to use part of their offshore allowance to take cash offshore, it certainly has become a lot more accessible, and there are a lot more options available to retail investors to take money offshore.
Yeah, just on the feeder funds, yes, you get paid out in rands, but you do get the exchange rate benefit. So if you want to take it out again, it is you won't lose that much.
Sorry, I should have probably been a bit more clear about that. You do absolutely get the exchange rate movement, because essentially what happens is that the management company whose rand feeder fund you invest in, they essentially take the cash offshore for you and then essentially use that cash to go and buy shares internationally. So you going and buying Apple and JP Morgan and ExxonMobil and whatever the case might be, and obviously you invested in rand, so it's fluctuating with both what the rand dollar exchange rate does as well as what the share price does. So you're fully exposed to the rand hedge, is I guess what you're saying. Yeah.
Viewers are welcome to send questions, events@moneyweb.co.za. Email those questions through, or just type them into the chat box on the YouTube channel. I just want to discuss the need and the how do you evaluate the options and what you need to take into account. Why would you move money offshore into dollars or euros or pounds and invest from an offshore vehicle as opposed to keeping it in South Africa and investing through feeder funds or through ETFs, which are listed on the JSE, which have got a lot of international exposure. What do you need to take into account to make the optimal decision?
Okay, so I think what you need to take into account to make the optimal decisions, also realizing that a lot of the companies that have Rand feeder funds are obviously a minute subset of the opportunity set that is available to invest globally. So if you have a substantial amount of capital to invest globally, and you kind of, you want to, it depends ultimately what you want to do with that, but so if you are planning on eventually immigrating and having access to that capital outside of South Africa, then I guess a Rand feeder becomes a whole lot less attractive as an investment option. If you are planning to just get exposure to some shares internationally, then that's when the Rand feeders come into account. However, what you do have to consider is that you are limited to the providers that offer you a Rand feeder option available to you. The world of investing globally obviously seems very daunting. There's thousands of asset managers globally. There's thousands of different strategies globally. How do you know that you are ultimately exposed to the correct strategy? And I think, the more complicated your needs become, the more complicated your designing your investment strategy becomes, I think the more kind of bespoke you have to be in the way you go about that. And what I mean by bespoke is saying, okay, well, the ETFs available to me on the JSE are not sophisticated enough. They don't offer the kind of diversification benefits I'm looking for. They don't offer the kind of global investment insights I'm after. And, as a result of that, my pool of capital that I have, being larger than the average retail investor, I potentially can have access to more tailored solutions globally, through the assistance of a wealth manager, through the assistance of a financial advisor. And, then it becomes an option of, okay, I've got my money offshore and I've got this universe open to me, but there's so many thousands of funds out there in the universe. How on earth do I go by filtering these funds? And that's when you can go either a multi-manager route or a single manager route. If you do know of good global funds, a multi-manager route can tend to be quite effective, because essentially what you're doing is that you're saying, I am hiring specialists globally whose job day in and day out is to review all of these thousands of global investment strategies and come up with, call it, the best of the best to combine into a portfolio. And I can leverage off of that research with my pool of capital that I have available.
Yeah, that is a very key point. But your wealth manager needs to assist you to take the best possible decision. I think very few individuals can do that. And you sit in front of your wealth manager and you say, listen, what should I do? And then the manager would say, do A, B, and C. Yeah. How well do you think the average wealth manager in South Africa understands this environment and can advise you absolutely optimally?
Sure, Rick, you're really putting me on the spot here. So look, I think it's gotten a hell of a lot better over the last 10 years. And the reason for that is just because there's been this enormous drive to externalize capital out of South Africa for whatever the reason might be. Lackluster economic growth, increased global opportunity set, better returns available offshore, well, up until the last 12 months, maybe better returns available offshore. So as that demand for global investing has skyrocketed, I think, the level of sophistication that wealth managers and financial advisors have in advising their clients has dramatically improved. I think maybe the one bias to be conscious of is that wealth managers, I think, would stick to brands that they know and brands that they understand. So they're traditionally going to stick to large South African brands with offshore capability. Whether that's the best offering or not, that remains up for debate. But, there are a number of offshore houses that now have a presence in South Africa. And are starting to build a brand for themselves in South Africa, and they have excellent capability globally. So if I had to answer the question, I'd say better than it was 10 years ago. Although I think that for the average South African investor, a multi-manager really is a compelling offering, because you are outsourcing that research of global manager selection to specialists.
But how do you, as a normal South African, approach a multi-manager? Is it a direct, or do you need to do it via a wealth manager, or can you actually go and sit in front of a multi-manager and say, listen, okay, I'm an individual, I've got a substantial amount of money, how do I invest it?
Yeah.
Shouldn't you work through a wealth manager?
Definitely through a wealth manager, right? So, I mean, the reality is that these large global multi-managers are probably not accessible to the average retail investor, but their wealth they are accessible to wealth managers, right? So, traditionally, the good financial advisors and wealth managers would know of the good multi-manager offerings that are out there. And a number of these multi-manager offerings do have, boots on the ground in multiple geographies, going and identifying these fund managers all over the world.
Yeah, just to explain the principle of a multi-manager, they are, call it asset managers who analyze other unit trust and collective investment schemes, not underlying companies or securities, and so you invest into the best possible funds as opposed to in the best possible companies. Companies, very interesting. What are the typical mistakes investors make when they invest offshore, or will they try or intend to invest offshore?
Yeah, I'd say the biggest mistakes there is that they wait for after the fact, because there's panic so there's a cabinet reshuffle. All of a sudden, Nhlanhla Nene is fired, and the rand goes to 18 rand to the dollar overnight, and that's when everybody wants to pile in and get their money out. That's often a mistake, because the currency is very volatile, and it retraces quite quickly off of these large standard deviations we see up or down. And I think traditionally, investors panic and want to take money out at the wrong time. I think that's one of the primary mistakes. I think the second mistake that investors make is that they try and compare global markets to local markets. So they say, well, the overall multiple of the MSCI world is 18 times forward earnings. On average, over the long term, it trades on 14 times earnings, so global markets are expensive. The reality is you're talking about 6,000 shares listed internationally. Yes, there are a handful of shares that are eye-wateringly expensive, but if you dig beneath the surface, there's a number of opportunities that still remain available. So beware of just looking at composite indices and making broad stroke assumptions about where global markets are going. So I'd say
emotion out of it, it's behavioral risks you have. Are there differences in yields from investing in, say, local feeder funds or exchange-traded funds versus moving money into foreign currency and investing from those platforms, probably into similar type of instruments? Yeah.
So I'd say that there wouldn't really be a big difference, but again, you're comparing a like-for-like vehicle, So if you've got a global fund that has a US dollar denominated version and a rand feeder version, typically your returns, your yield are going to be exactly the same in the vehicle over time. There's going to be no difference between them. But obviously, as we mentioned earlier in the discussion, the only limitation you have with the rand feeder funds is you're limited to the providers that have the rand feeder funds, which is obviously a very small subset of the entire global universe that's available.
Okay, interesting question from Tando. Should I have a foreign will and appoint a foreign executor? That's obviously if you have money offshore invested in assets there, and again, that is a very, very important difference between the two, because if you have money offshore you've actually transferred it out of South Africa, you will need a will. If you keep it in South Africa and you invest in a feeder funds, you don't.
That's 100% right. So you've hit the nail on the head and answered the question.
But not many people take that into account.
That's right. So, and these are the important nuances to understand. And there's also this confusion around, well, if I'm in a rand feeder fund, all of a sudden my money is offshore. Yes, your returns are offshore and your investment opportunities are offshore, but your money in terms of its home is in South Africa still. So, that you don't require a foreign executor or a foreign will for anything that's in a rand denominated vehicle. But in a dollar denominated vehicle where you've externalized your money yourself, or you've externalized your money through a list platform or through a broker that offers you a part of their foreign allowance, as we mentioned earlier, again, there your money is externalized, and there you will need a foreign executor and a foreign will.
Do you know where the term feeder fund comes from? Because it's not a very sexy name for a pretty important investment vehicle in South Africa.
I have no idea where it comes from.
Maybe absolutely it feeds through, but maybe the industry can look at that and get a better name. Let's see here. What about risks related to the exchange rate? And I think a lot of people look at foreign investments, and one of the primary reasons they want to invest offshore is they want to hedge themselves against a rand devaluation, which always seems to be imminent. How should people think about the exchange rate when they decide, and not only on whether to invest, but also which vehicle to use?
Yeah, so Rick, this is a question we typically find very difficult to answer. And the reason is that the exchange rate in and of itself is a very emotive thing in South Africa. You know, we're one of the few countries in the world where the average person knows what your exchange rate is versus the US dollar. It's continuously quoted. We are a very liquid emerging market currency. And I think the reality is that it's probably the most emotive part of investing offshore, is that people say, I just want to get my money out of rands. And because it's the most emotive part, I think, traditional or investment professionals are probably try and stay the furthest away from that debate. So the advice we'd give is that, South Africa is less than 0.5% of the global economy. That is your starting point. Forget about the rand, forget about what the politics of our country are. South Africa is 0.5% of the global economy. There must surely be significant investment opportunity, out that doesn't exist in South Africa. It doesn't matter how well run our country is. You cannot get access to the same investment opportunity. And, you just have to look at the tech sector. South Africa, we've got 2 tech shares maybe. Globally we've got 50 tech shares. In South Africa we've got 1 oil and gas play. Globally we've got 20 oil and gas companies. And by the way, oil and gas companies, as you know, have done incredibly well over the recent past. So
as did Cecil.
As did Cecil, yeah. So I think with regards to offshore investing, forget about the currency and say my portfolio needs to be optimally diversified and be exposed to the best possible investment opportunities. Yes, the rand has to be a part of that debate, and when the rand has shot out 15%, it isn't the best time to take money offshore, and when the rand has strengthened 30%, it probably is a good time to take money offshore. But it shouldn't be the primary driver of your decision. You got to park it on the back burner. And, maybe the last 5 years or 6 years are a great example. The rand has gone nowhere. It's been very volatile in that period, but our starting point and our end point are pretty much exactly the same. So any returns you would have gotten would have been from what underlying investments did you have globally, and that was by far the bigger driver of returns over that period.
Yeah, and it seems as if the exchange rate has, the correlation to political instability have reduced. So it's not as correlated anymore. We have a Zonda report which was released yesterday, which contained really airy stuff, and the rand didn't really move. That's right. And I think it's because it's so liquid, it's maybe the exchange rate is influenced more by global trade than with local political developments. Interesting question. Can you change the structure of foreign investments at a certain period in time? Is it a complicated process? Are there tax implications? What should you take into account?
Okay, so I'll start off this discussion with a precursor that I am not a tax expert. So you most definitely would need to speak to a tax expert. But in terms of changing the structure of the investment, I know that there are vehicles you can use, which minimize your tax liability and enable you to change the nature of your underlying portfolio, as frequently as you like while you are within the structure, and the tax event is triggered once you leave the structure. So let me maybe put more color to that, right? If you go through a global endowment, a global endowment structure that, it's wrapped in an endowment, and as long as you remain within the endowment structure, there's no tax event that's triggered by switching from an equity fund into a fixed income fund.
Capital gains tax.
So only once you exit the endowment structure. So that's the important. Once you're in the endowment structure, there is no tax. But once you exit the endowment structure, that's when you trigger your tax event.
Yeah, I think get a tax professional. We had a discussion earlier, and it seems as if there are many events that may trigger tax, which people don't really take into account. The geographical destinations of money. You know, obviously foreign investments, it's not a homogeneous thing. There are many companies. There are sectors which you don't have in South Africa. You've alluded to it, defense at the moment, and luxury goods, biotech, and the like. So you need to take that into account. But how do you allocate the not only geographies, currencies, asset classes, and do you think local wealth managers can do that?
Yeah. So I think the asset allocation debate is a complicated one. You know, and obviously, if you're looking at asset allocation in terms of traditional fixed income, equity, property, you know, I think there's some phenomenal opportunities globally in the equity and the property space, you know, and you've got so much diversification by sector there. I mean, if you look at the property, you've got industrial, you've got commercial, you've got, you know, you've got warehousing, you've got multiple options in each of those sectors. You have single family, you have multifamily. So, you know, I think that the level of diversification you get in equity and property globally, there are incredible opportunities. I think with regards to fixed income, it's gotten a little bit better over the last 12 months because we've seen those yields back up quite a lot, you know, within developed markets. But, you know, South Africa still obviously has much higher yields than are available internationally. You know, so generally, you know, I think the asset allocation debate, you know, local, I think would be better with regards to fixed income, but certainly there's a lot more opportunity in equity and property globally. You know, so and from an asset allocation perspective, you know, I think the wealth managers may not be able to do that themselves, or some may not be able to do that themselves, but they certainly do know expert asset managers who have incredible asset allocation products, who have incredible equity products. You know, and I think again, you know, if you look at this is where an advantage of a multi-manager might come in, because, you know, you can start to blend asset managers of different styles, so value and quality and momentum, and obviously each of these styles go through various cycles where they outperform. And, you know, you as an average investor, it becomes very complicated to know which style do I allocate to, which region do I allocate to. And again, you know, that's where a multi-manager can give you the best of all and pick specialists within geographies. They can pick specialists within investment styles, and you can ultimately leverage off all of that research by investing in these vehicles. So ultimately, wealth managers would know who are the optimal offshore, what is the optimal offshore strategy for to meet your individual needs.
Yeah. There are a few questions about local structures. For example, exchange-traded funds. You can go to Signia, for example, and in South Africa buy an MSCI World Fund, American Fund, Developing Market Fund, and that is in rands, and that's a very good product. Not only Signia's, but you can get it from many different asset managers. You can also use a platform like Easy Equities and buy stuff in rands, also you know, in rands into foreign stocks and foreign companies, which is also a good product. But one big advantage I see of investing through those structures, you can sign a debit order on your bank account, yep, and every month pay 100 Rand, 1,000 Rand, 2,000 Rand, 10,000 Rand, whatever the amount is. And you can't do that through an international structure.
Absolutely, Rick. And you hit the nail on the head. And that's why I think that this has been the big development in offshore investing over the last 10 years. It's just how much more accessible it has become. So, you know, an investor out there mustn't feel like this is not accessible to me because I can only invest 200 Rand or 500 Rand a month. It most definitely is. And platforms like these ETFs and, you know, trading these ETFs that are listed on the JSE through any broker in South Africa, you know, and the various brokers have various minimum amounts, but they're not big, you know, and there are brokers that have even lower minimum amounts. So you're 100% right that the optionality exists all the way from the most basic 100 Rand a month debit order going and buying an MSCI World ETF to the most complicated tax structuring, correct vehicle for your estate and your will and your taxes, and selecting the right offshore managers and selecting the right asset allocation to meet your specific investment requirements. From this end of the spectrum to that end of the spectrum and everything in between now exists in South Africa, and offshore investing is a lot more accessible.
So if I understand you correctly, is the structure doesn't really matter all that much. You need to have foreign investments in your portfolio, And the choice of investment is a lot more important really than if you to take the money out relative to investing it in rands with access to offshore markets.
That's a fair statement, you know, and I think, and that's how the playing fields have leveled, you know. So I guess the more sophisticated they invest in, the larger the sums they have to invest, the requirement for the tax benefits and their state benefits comes in. And I guess the one advantage they have over, say, the smaller amount investor is that, you know, they can get access to sophisticated wealth management and financial planning that can tailor an investment strategy specific to them. Whereas, you know, guys on this end of the spectrum are buying an off-the-shelf product, but again, a very good off-the-shelf product. Nothing wrong with it. And it is exposing you to global companies like Apple and Google and ExxonMobil and JP Morgan and, you know, all these companies and brands we consume every day in South Africa but can't invest in on the JSE. It still exposes you to those brands and in a very cost-efficient manner.
Yeah, and again, I don't think you're disloyal to South Africa if you go that route. I think it's just a good, solid investment advice. Interesting question regarding inflation in different geographies. Now, inflation currently is a big topic, and it has become a significant element and issue you need to take into account in your investment strategy, because it's, you know, a year ago we didn't have an inflation problem. Now suddenly we have the US close to 9%. South Africa has gone from 4.5% to over 6.5%. And that will trigger interest rates. So there will be a swift change in the dynamics of the world markets. How should you approach that?
Yeah, so it's a scary time, Rick, and a lot of the volatility we've seen in markets over the last 6 months or so. And I'm sure you've had other guests talk about that. You know, the S&P is officially in bear market territory. You know, we more than 20%
is even more.
Even more, exactly. You know, so and the primary driver of that is the fact that inflation is going higher, and central banks have to do something about it, and they have to tighten monetary policy much quicker than they thought they would have had to a year ago. So, in terms of what you do about that, Rake, I mean, I think it depends on your time horizon. You know, if you've got a 2 or 3 year time horizon, a 22% crack in the market is disastrous. You know, you wonder whether you can recover from that. But if you've got a 10, 15, 20 year time horizon, these are market events that happen. You know, markets go in cycles. Currently, we're going through a bear cycle after more than 10 years of going through a phenomenal bull run. So at some point, a drawback is expected. I think the important thing is to be diversified. You know, don't have all your eggs in one basket. Don't be invested in a manager that only likes technology shares, or don't be invested in a manager that only likes the growth style. Spread it across managers of different investment styles, spread it across managers in different geographies, and ultimately diversification is your friend in this environment.
And keep in mind, a bull market happens over a long period of time. A bear market happens quickly. So the longer you are within a bull market, the better it will be, because it actually takes a lot longer. Then, what are the trends you are seeing regarding the outflow of money from South Africa?
Sure, yeah. So, I mean, there's, as we mentioned at the start, you know, there's obviously been significant demand for these offshore products, and that's why we've seen the proliferation of solutions, you know, over the course of the last 10 to 15 years. You know, 15 years ago, someone who had 100 Rand a month to invest had pretty much no options offshore. You know, today, at the tap of a couple of buttons, they have multiple options at their disposal. They can go buy a tech ETF, they can go buy an S&P ETF, they can go buy a FTSE 100 ETF, you know, and they don't have to take a cent of their money outside the borders of South Africa. And the reason that has happened is because there's been an enormous exodus of capital from South Africa. And, you know, as we mentioned, you know, that has been the reason, because of, you know, obviously some of it has been emotive investing. You know, you drive over a pothole, all of a sudden you've got to replace your rim, and, I want to take all my money out of South Africa. And some of it has been, you know, the world has become smaller, and people have gotten access to more information, and they've realized that there is this broader opportunity set out there, and I want to be able to tap into this.
But do you see more money being converted from rands to dollars than people, for example, investing in feeder funds?
Yeah, that's a good question. Yeah, so I'd say there is more. There is more converting from rand to dollars, and I think that's the primary driver behind that has been high net worth investors traditionally don't use rand feeder funds. Because they're looking to take their money out of South Africa and have optionality in terms of what they do with their money from that point. And then obviously the big driver of capital flows are retirement funds. And retirement funds have no need to use feeder products. Up until recently, they could take 30% of their assets directly offshore, and now they can take up to 45% of their assets offshore. And that's currently a very hot debate at the moment in terms of what is the optimal offshore allocation. And a lot of investors have already started capitalizing on that and gradually started increasing their direct offshore exposure.
What are the difference in fees from feeder funds as opposed to direct investments offshore?
Yeah, so that's a good question. So feeder funds would traditionally be slightly more expensive, and the reason for that is you've obviously got this added layer of cost of needing to have a South African registered vehicle. So you're ultimately, again, investing in exactly the same end product, but you're accessing it through an additional layer, shall we call it, and that layer needs to incur some fees.
Yeah, but there will be a difference between an actively managed feeder fund as opposed to an exchange-traded fund. So it's not a clear cut, it's more expensive to invest in feeder funds. There are other options too.
Yeah, sorry, the way I answered the question was really about comparing like for like. So let's take, for example, and I'm not affiliated to any brand, but let's say the Allan Gray Orbis Fund. If you're investing in the Allan Gray Orbis Fund by taking your money into London and investing in pounds, or you're investing in the Allan Gray Orbis Rand Feeder Fund, traditionally the Rand Feeder Fund would be more expensive. That's leaving out the fact that you can get ETFs that are Rand feeders that are obviously going to be much cheaper options than a direct
75 basis points, 100 basis points, what is the ballpark?
Sure. So it obviously depends on the service provider, but I'd say that, the Rand feeder funds are typically between 20 and 25 basis points more expensive than the direct offshore option of the exact same fund again. So again, using the example of the Allan Gray Orbis offshore versus the Allan Gray Orbis Rand feeder.
Yeah, I think that's also you need to investigate the fees, because that could also make a difference. I think we had fantastic questions. I think this is a fantastic discussion, and I think the theme of this morning was, listen, diversification is king, do it for the right reasons, go and pick asset classes offshore that are relevant, and base it on valuations. And interesting, I think that word wasn't used too often today. It seems like political risk is one of the things that asset managers actually watch at the moment. And is that short-term noise? Is it the signal? The idea is that fund managers react to signals as opposed to noise. But they can, with inflation and interest rates that may rise soon, do you regard that as noise or as a signal? Listen, there is a fundamental change in the direction of the investment world.
Yeah, so I think it depends on the signal, right? There are obviously certain variables which are far more relevant than other variables. We'll park aside political risk because that is impossible to predict and impossible to know which way it turns out. But things like inflation, those I think are very relevant. And the reason why inflation is relevant is, remember, what we do in our industry is ultimately try and forecast a set of cash flows for a company and discount those cash flows back to the present value. And that discount rate is a big part of what the present value of that company is worth. And if inflation is overshooting to the extent that it is, that discount rate has to go up because central banks are increasing rates. And all of a sudden, if your cash flows are delivered in 5 years' time or 2 years' time, that's a lot more valuable than your cash flows being delivered in 20 years' time. And you made the point earlier on that the NASDAQ has been much worse than the S&P 500. And that's exactly why, because a number of the companies on the NASDAQ are delivering their profitability 15, 20, 30 years out. And when you're discounting that back at a higher rate, that's worth significantly less. So depends on the macro variable, but things like inflation and how that impacts interest rates, I think that is very relevant to what asset managers should be thinking about at the moment.
Nadir, thank you so much for your time today. I think this is a fascinating discussion, and I think people need to make investment decisions for the right reasons and take emotion out of it. Yes, we're seeing a lot of noise in the market at the moment, but it shouldn't affect a long-term decision. Thank you so much for joining us for this session. We'll be back shortly.